Hello all and welcome back to Finominal UK for another portfolio review. In today's portfolio review, we're going to be taking a look at the Scottish Mortgage Investment Trust. So, Scottish Mortgage's stated purpose is to identify, own and support exceptional growth companies, both public and private, with 35% of this trust sitting in private companies such as SpaceX, ByteDance, as well as Stripe. Noting total assets with 15.43 billion. It's quite a popular investment trust indeed. And in regards to actual allocation towards public and private companies, just under 65% of this particular portfolio is invested in public companies, with just over 35% invested in private companies. So what that will mean for advisors, speaking to clients, 65% of this portfolio is repriced daily, with 35% of it actually lagging, as that's actually repriced quarterly. So, which makes for an interesting point on benchmark selection, as Baillie Gifford has benchmarked against the FTSE All-World, which the problem with that is that SMT is 56% in information tech, as I'll show you when we head over to sectors in the portfolio analyzer on Finominal, and 89% active share means there's going to be little overlap with the index, effectively, especially with those private companies' holdings as well. So comparing SMT to All-World, tells you very little about whether the managers are adding value or just riding the tech wave. Okay. What I think would be a more appropriate benchmark would be the iShares Global Tech ETF, as that's tech focused, such as SMT, also with a growth tilt. It's got 127 holdings, all publicly traded, and is a much cleaner comparison on the public tech portion. Just to note in regards to how I'll be displaying this within Finominal, I'm doing this as a dynamic portfolio, so we've got the SMT tracker since inception, but I have rebalanced this then based off of this portfolio valuation as of the 31st of December 2025. So from that date, I rebalanced it with the most recent underlying holdings for the public sector, and then for that 35% element for the private companies, I've actually allocated that back into the SMT ticker. So just a caveat, that will skew things a little bit from December 2025 onwards, but as we'll be looking at 5-year timeframes and since inception data, that's not going to make much of an issue whatsoever, and it will allow us to do full factor look through analysis. That makes sense. Okay, so now that's out the way, let's head over to Finominal for our full portfolio analysis. So looking to since inception data with the RXN as the benchmark, we can see SMT looks on the face of it a very positive, highly performing active fund, giving returns above global tech as well. So fantastic to see initially. And they've also done this at a slightly cheaper fee as well. Ongoing charge for SMT is 0.31% versus IXN at 0.39%. But let's change this now to look at the last 5 years. That's going to be most relevant. Captures the COVID rally, 2022 crash, recovery, and current private allocation is more representative. Okay. Okay, as we can see, this changes things quite considerably, is what I would say. Considerably underperforming global tech for a portfolio that's meant to be tilted towards tech. So that's interesting to note initially. CAGR minus CAGR minus 3.3% versus the iShares Global Tech of positive 15.6%. SMT has done this with increased volatility as well at 30.2%. And just to note as well, that's going to be slightly smoothed as well because of 35% of this portfolio only being rebalanced quarterly. So that can certainly make for quite volatile price movements, is what I would say, 4 times a year. Noting max drawdown as well, considerably higher within SMT than IXN, almost double the amount of max drawdown versus each benchmark we're using. Negative Sharpe ratio for SMT minus 0.21 with a positive Sharpe ratio for IXN. I think that's pretty much all to note initially on the face of portfolio benchmarking. We can look at holdings benchmarking, which is why it's so beneficial to create dynamic portfolios within Finominal as opposed to just looking at tickers. We'll see that as we go over to factor exposures as well. However, to keep things timely, I will look over this, and instead we'll go over to asset classes and markets. As we can see, mainly invested in equities, as we'd expect, with a 51% in large cap, 43% in mid, and 6% in small. So just to note, as we can see, the IXN benchmark, it's not meant to be perfect on every single metric we're looking at. As mentioned, part of SMT, 35% of this portfolio isn't publicly available. So just to note that the main reason why using IXN is for intent with that tech tilt, growth tilted. But let's get over to sectors, and we're seeing this clearly here. 56% invested in information tech and 16.1% in consumer discretionary. Other notable ones being healthcare, industrials, and financials, and others. Let's look now to alpha and factor exposures. I am going to change this I'm just going to reset this so we can see it's November 2001. We've got in here. And let's have a look at the equity factor exposures over time. Okay. So beg your pardon. Let me head over. Excuse the clicking around. So return-based factor exposures. Overall, we can see a negative equity factor exposure to the value factor, which we would expect to see. And also looking at risk sources, the majority of risk attributed to the MSCI All Country World Index, as we'd expect. But and the same with that value factor, we'd expect to see that having a negative equity factor exposure to the value, given the companies we're invested in. And if we head over to alpha attribution, just to confirm we are on this time frame, lovely, where we can see alpha consistency of 11 out of the last 18 years and cumulative alpha of 326.97%, a tracking error of 24.4%. So overall, cumulative alpha quite strong. Alpha consistency not that great, but let's change the time from now just to look at the last 5 years, and this is where we'll continue our analysis as well with this time frame in mind. With alpha consistency of 3 out of the last 5 years and a negative cumulative alpha. That's no surprise as we saw with that initial overview tab. Again, we can look at holdings level analysis. So one thing that's great about Finominal, you can go as technical or as non-technical as you want, really. So I'm trying to make this analysis as broad for all, effectively. We can look at risk and return contributions of those underlying holdings, but let's actually go to drawdown analysis and stress testing. I will actually change this back to the longer time periods. Of course, the drawdown and stress testing, it's very it's better to see that. Okay, and as we can see, considerably stronger drawdowns than global tech, as we saw on that initial benchmarking tab, especially in more recent times, looking 2022, quite a strong sell-off nearing what we saw there, minus 57%. And after the GFC, we saw as far as what was there, minus 57%. So very, very strong drawdowns for this particular investment trust. And that's one main thing that I would note for clients. This is a risky fund, is what I would say. So to be noted. Diversification, which is mainly just going to be in equities, majority in US and UK. So that's what I would say on diversification. Fee reduction, I think it's already quite it's already very competitive at 0.31% ongoing charges. You could look to replace, with benchmarks, portfolio simplification. However, I think if you did want to invest in tech, global tech, such as their mandate, probably a more appropriate asset to look at, maybe IXN is what I would say, just because we've seen considerably less volatility and higher CAGR as well. So that's one thing to note for this particular analysis. But that does bring me to the end of this portfolio review. I do hope that was a little bit interesting than usual. But of course, if there are any funds, portfolios, investment trusts you want me to analyse, or likewise, if you do want to learn more about how you can create dynamic portfolios and such within Finominal, please do let me know in the comments. Other than that, like, subscribe, and we'll see you in the next one. Thanks all.